My greetings and salutations to all. In the ongoing series of Finance for Everyone, today we have Investments and Market, an overview. So the flow of the lecture goes like this. First, we will be talking on the definition aspect of investment and its importance, followed by types of investments, understanding of the financial markets, a difference between stock and bond market, what are the factors that impact the market performance, and the last is the investment strategies and the portfolio management. So investment is the allocation of resources, most often the money, with the hope of the later producing revenue or profit. By investing your money in the assets like stocks, bonds, real estate and the mutual fund, among others, you can increase your wealth over time. So the investor's financial objectives, risk tolerance and the time horizon are common elements that influence the investment decisions. When choosing an investment, it's very critical for the investors to understand the trade-offs between the various types of assets, varying the levels of risk and the potential return. So the first is a wealth creation. By investing their money in the assets that increase in the value over time, people and companies can create the wealth. Followed by protection against inflation. Investments that provide returns that are higher than the rate of inflation can fend off the consequences of inflation by preserving and boosting the buying power. The next is your diversification. A portfolio's exposure to the market volatility can be lessened by investing in a range of assets which can help spread the risk. The next is your retirement planning. Investments are a crucial part of retirement planning because they help people create a nest egg that will support them in their later years. Followed by economic growth. Investment is a key factor in economic growth since it encourages the long-term development, innovation and the job creation. The next is your business funding. Investments give companies the money they need to grow, innovate and produce the new goods and services. Followed by the tax advantages. Some investments kinds come with a tax advantage, such as tax deductions for retirement account contributions and the tax-free growth of investments keep in specific accounts. So overall, investing is a very crucial part of both the personal and the business strategy since it fosters the economic growth and the long-term wealth creation. Now coming on to the types of investments. The first is the bonds. The government, business and other organizations issue bonds as a form of debt to raise the money. By purchasing a bond, you are effectively lending the money to the issuer at a fixed interest rate for a predetermined amount of time. Although they normally carry less risky than stocks do, the bonds have a lesser potential rewards. The next is your stocks. The stocks are the ownership shares in a firm often known as equities. So purchasing stock entitles you to a portion of the company's profits and makes you a part owner of the business. The bonds are typically thought of as being less risky than stocks, but the stocks also have a bigger potential return. The next is your mutual funds. Managed by a qualified investing firm, a mutual fund is a collection of the stocks, bonds and other assets. So when you invest in the mutual fund shares, you combine your funds with those of other investors to buy a diverse portfolio of assets. Mutual fund provides professional management and diversity, but they also include the cost and the fees that can lower the returns. Exchange Trading Funds, that is ETFs. ETFs offer a diversified portfolio of assets, much like mutual funds do. However, ETFs trade like stocks on an exchange, so you can buy and sell them at a market price at any time of the day. Although ETFs are frequently regarded as more adaptable and affordable than the mutual funds, they are not without risk, including the tracking mistakes and the liquidity concerns. Other investment options include the real estate, commodities, and alternative forms like hedge funds and the private equity. The type of investment a person makes will depend on their financial objectives, the level of risk tolerance, and investment horizons. So, before making a choice, it's critical to do some study on each investment option and comprehend the dangers and the potential returns. So, understanding of the financial markets. Yes, here is a summary of the financial markets with an emphasis on many market types, out of which the first is financial market definition, a system that enables the transfer of money between the investors and the borrowers is the financial market. It is a trading platform for several financial items, including equities, bonds, currencies, and commodities. The second is your different financial market types. The second is your money market. The short-term debt market allows for the trading of financial securities with the maturities up to 1 year. The certificates of deposits, commercial papers, and treasury bills are few examples of money market instruments. The next is your capital market. The financial instruments with a maturity of more than a year are traded on the capital market, which is a long-term debt and equity market. The stocks, bonds, and the real estate are few examples of capital market instruments. Next we have is a foreign trading market. The currency trading takes place on this market with the trillions of dollars in trades every year and every day. It is the largest financial market in the world. The commodity markets. The commodity market is where the agricultural items, metals like gold and silver, liquids like oil are traded. The producers and consumers of the commodities utilize this market as a hedge against the price changes. Let us now talk about the derivative market. The derivative market is the marketplace for trading the financial instruments like options, futures, and swaps. These tools are used to control the risk, protect against the price swings and the market predictions about how the market will develop in the future. The next is your debt market. The bonds, debentures, and the notes are examples of fixed income securities that are traded on the debt market. To raise the money, business, government, and other organizations issues these securities. The next is your equity market. The stocks or company shares are traded on the equity market. The shares are purchased and sold by the investor in the hopes of generating a profit through dividends and the capital growth. The financial market as a whole is a sophisticated ecology that is essential to the world economy. The investors and the business wishing to make a wise investment decisions must have a thorough understanding of the many types of financial markets and the products traded within them. Now coming to an overview of the stock and the bond market, including their characteristics and performance. So let us first do the features of the stock market. The first is the ownership. When you purchase stock, you take a stake in the business. Next is your volatility. The stock values can fluctuate dramatically in the near term since the stocks are often more volatile than the bonds. The next is your returns. Historically, stocks have outperformed the bonds in terms of returns, but previous performance is no guarantee of the future success. The next is your chance. Compared to the bond market, the stock market carries a higher chance of the financial loss. Next is your liquidity. In general, the stock market is quite liquid, making it simple to immediately acquire and sell the equities. The next is your portfolio diversification. Portfolio diversification is made possible by the stock market broad selection of the investment alternatives. Market characteristics for bonds. The first is your debt. By purchasing a bond, you are essentially lending the bond's issuer the money. The next is your income. Since bonds typically pay a fixed rate of interest, they guarantee the investors a steady flow of income. The next feature is your risk. Due to the predictability of the income stream and the lower default risk, the bonds are often thought of as being less hazardous than equities. The next is your returns. The bond returns are often lower than the stock returns. The next is your liquidity. The bond market, particularly for less traded bonds, may be less liquid than the stock market. Now we talk about the portfolio diversification. Portfolio diversification is made possible by the bond market, which likewise provides a wide range of investment choices. It's crucial to remember that these qualities are not absolute and can change depending on a number of variables, including the market conditions, the company issuing the stock or bond, and the particulars of the transaction. Now coming on to the activity on the stock market. The first is returns. Over the long term, the stock market has traditionally offered the larger returns than the bond market. Previously, the performance is not a guarantee of the future outcomes. Then is your volatility. The prices on the stock market typically fluctuate more quickly than on the bond market in a reaction to changes in the market conditions. The next is we have a chance. Compared to the bond market, the stock market carries a higher chance of the financial loss. Next we have is a correlation. Because of the stock market generally low correlation with the other stock classes and the asset classes, the stock can help a portfolio diversify. Next we have is the economic indicators. A number of economic indicators including the gross domestic product, unemployment rates and inflation can have an impact on the stock market performance. Next is your earnings. Both the success of certain stocks and the performance of the stock market as a whole can be significantly impacted by a company's earning reports. Now let us do about the bond market. The bond market performance. In this, the first is your returns. The bond typically offers the lesser returns than the stock, but they can nevertheless generate a steady income. The second is your interest rates. The bond market performance is directly correlated with the interest rates because the bond values typically decline as the rate rise and vice versa. Next is we have a credit risk. The credit worthiness of the issuer can have an impact on the performance of certain bonds. The bonds from the riskier issuers often have higher yields but also have a large default risk. Next we have is the inflation. As the prices increase, inflation may cause fixed income from the bonds to lag behind, decreasing the value of the bond returns over time. Next is we have a diversification. Because bonds often have low correlation with the equities and other asset types, they can help a portfolio diversify. Next is your market conditions. A number of market factors, including the geopolitical developments, the release of economic data, and the shift in the investment attitude, can have an impact on the bond market. So let us now talk about the factors that impact the market performance. There are numerous factors, including the following can have an impact on the financial performance. Out of this, the first is interest rates. The performance of the financial markets can be significantly impacted by changes in the interest rates. For instance, as the investors may decide to move their money away from the riskier assets, increased interest rates might result in the lower bond and the stock values. The next is your inflation. Because it gradually reduces the purchasing power of the money, inflation can also have an effect on the financial markets. Higher interest rates brought on by the inflation may have a detrimental effect on the bond and the stock prices. Next is your geopolitical events. Political and geopolitical developments can significantly affect the state of the financial markets. The financial markets may experience uncertainty and volatility as a result of, for instance, a significant terrorist attack or a conflict between the two nations. Let us now talk about the economic indicators. The release of the economic data, including the gross development product growth, unemployment rates, and inflation, can have an effect on the financial markets. The stock prices can rise or fall in response to the economic data, depending on whether it is positive or unfavorable. Next we have is the corporate earnings. A company's performance as well as the earning reports might have an impact on the financial markets. The positive earning reports can cause the stock prices to rise and the negative earning reports can cause the stock prices to fall. Next is your central bank policies. The Federal Reserve in the United States, for example, can have an impact on the financial markets via its policies. For instance, if a central bank announces a reduction in the interest rates, this may cause the bond prices to fall and the stock prices to rise. Investor sentiments can also affect the financial markets, which brings us to a number 7. Stock prices can rise when the people are feeling optimistic, while they might fall when the prices are feeling down. Let us now talk about the overall concept of portfolio management. Investors can utilize a variety of different investment methods to develop a portfolio. Here are few most widespread. The first is your value investing. This technique entails finding the stock that the market has discounted and buying them at a bargain. The next is your growth investing. So this method entails making investments in business whole earnings and revenue are anticipated to expand faster than the average. Next is your income investing. With this method, you will buy securities like bonds, dividend-paying equities, and real estate investment trust that produce a steady source of income. Let us now talk about the index investing. This method involves buying the stocks or the bonds that follow a certain market index, such as S&P 500, in a diversified portfolio. Investing with a momentum. Investing with momentum is a purchasing shares of the companies or other securities that have recently performed well in the expectation that the trend will continue. Then we have contrarian investing. So this method entails the buying stock or other securities that are undervalued by the market in the hope that their value will afterwards increase. Next we have is buy and hold investing. So in this technique, stock or other securities are purchased and held for a long time, often years or even the decades. So the period for which the investment is held is substantially long. Then we have is the asset allocation. This method of risk management and achieving the specific investing goals entails the diversifying a portfolio among various asset classes, including the stock, bonds, and the real estate. Then we have a tactical asset allocation. So this method actively modifies an asset allocation in a portfolio in response to a market conditions and other variables. Let us now talk about further in this regard. So there are just a handful of the numerous investment ideas that buyers must apply to create a portfolio. The secret is to select a strategy that fits your investment objectives, the risk tolerance, and the time horizon. You should also routinely examine your portfolio and make the necessary adjustments. So these are just a handful of the numerous investment ideas that buyers might apply to create a portfolio. So the secret is to select strategically that fits your investment objectives, the risk tolerance, and your time horizon. You should also routinely examine your portfolio and make the necessary adjustments in this regard. Now moving to the process of managing a portfolio or a group of investments with the aim of accomplishing a certain set of financial objectives. It is called as portfolio management. The following are the main traits of the portfolio management. Out of this, the first is diversification. To lower the risk of the loss, one of the major objectives of portfolio management is to spread the investments among several asset classes, such as the stocks, bonds, and commodities. The next is your risk management. By balancing the risk and return of each investment within the portfolio managers hope they manage risk, and to reduce the risk, they could employ the techniques like asset allocation and hedging. Next is your active management. Portfolio managers and the portfolio managers in regard of active management, they regularly assess the portfolio's performance and make necessary adjustments in reaction to shifting the market circumstances, economic trends, and other variables that may have an impact. Monitoring the performance. To determine whether the portfolio is succeeding in its objectives, the portfolio managers frequently compare the portfolio's performance to its benchmark and investment objectives. Next is your asset allocation. To achieve the intended risk and return profile, the portfolio managers choose the right combination of various asset classes and individual assets. The next is your investment selection. The portfolio managers choose specific investments based on a range of variables such as their potential for growth, ability to generate income, and the degree of risk. In general, portfolio management entails a variety of actions aimed at minimizing and maximizing the performance of a group of investments while controlling the risk to meet certain investments goals. Thank you very much.